Mark Twain is famously quoted, "History doesn't repeat itself, but it often rhymes." If that is the case, then the Chinese real estate market is about to have a rap battle with the 2008 global financial crisis. So this article from the Wall Street Journal, "The Folly of China's Real Estate Boom Was Easy to See, but No One Wanted to Stop It," is an incredible telling of a set of investors that kind of figured out what was going on in the China real estate market early on and kind of the bets that they made against it, and then kind of how they watch this play out. Now, if you're at all familiar with the 2008 global financial crisis, especially the story kind of presented in The Big Short, the kind of famous movie, then you're going to see a lot of similarities between that story and kind of what is going on in China. So let's dive into the article because there are so many interesting things that come out of this. And then at the end, we're going to talk about kind of the differences between this and the 2008 global financial crisis. All right, so it starts with this hedge fund manager going to Tianjin Golden Metropolitan, where he finds $1 million apartment buildings, an office tower bigger than the Empire State Building, and total square footage to exceed the land area of Monaco. Now, I've been to Monaco. It's not an enormous place, but it is a pretty big city. And this is just like one development project in China. So he asks, like, what is the plan to attract buyers to this? And the marketing agent says polo. And then this is the best line in the entire article. "Then I realized that the vision was that international executives would come to Tianjin and set up their corporate headquarters here because they liked polo." So he's kind of shocked by all of this. He heads back to the States, and in 2016, he starts shorting the Chinese real estate market, right? And the rest of the story over the next couple of years really starts to tell the story of how the companies came to realize what was happening, but they were so convinced that the Communist Party, the Chinese government, would bail out the real estate industry because of how important it was to their growth model that they really just keep going along. And then you start to see what he's uncovering over the next couple of years, because we have to remember, we have hindsight. We now understand the timeline. He starts this in 2016, but we know that the Chinese real estate market doesn't really start coming apart until 2021, 2022, and it's kind of still coming apart now. This is very unlike the 2008 global financial crisis, which I'll get to the end. So some of these accounting practices, one of the best is down here. Evergrande has 400,000 parking spaces that it's struggling to rent or sell, and yet they are still valuing them on their sheets as $20,000 per space. In here you see, it's in here somewhere, I don't remember, you see that many of these companies are using like their own personal assets for collateral on loans. So effectively, it would be like if Amazon took out a loan and the collateral was Jeff Bezos's house. Right? Just very, very strange things going on. So he's watching all of this, but the market still keeps killing it. For example, in 2017, Evergrande, who at this point he's shorting, is up 460%, right? Shocking numbers. And this is exactly what happened in 2008. Even when those that figured out what was going on with collateralized mortgage obligations and things along those lines, they have to watch the market continue to scream up through all of this, right? Kind of cringing, and they're having to pay tons of money in order to maintain their short positions. That's exactly what these guys fell into. So then he starts figuring out more of these problems. So he figures out this hole digging. So effectively, the companies are hiding their debt in subsidiaries, right? So smaller companies that they own, but they're making it so that the debt is not available, as far as I can understand it, on like the 2 days that they have to report the standing of their company. So effectively hiding all of these debt in these subsidiaries that they supposedly don't have access to when they need to report it. Of course, a lot of individual investors get caught up over this. So this is a 35-year-old, but in college she started buying real estate. Her first property was $70,000. Recently paid almost $4 million for a property in Shanghai. You find out later in the article that most of these properties have all gone to zero. They look like this or like this. Lots of these properties are just really have no hope of ever being filled. And it's important to understand that in China, you will often buy the property before it's ever built. So some of these properties, people are paying mortgages on before, and they're never going to get finished, right? So this is a massive problem in China right now. Okay, and then later on, then just like 2008, all of the banks and the rating agencies start to get kind of in bed with all of this. The banks are seeing such record profits making loans to these real estate developers that they're starting to give incentives and bonuses for bankers who can close it. Most bankers are very resistant to turn down a deal because it will like affect the way they're rated in their company. And then the rating agencies, who famously screwed up the 2008 global financial crisis, the 3 Chinese domestic companies awarded AAA ratings. That is the credit rating of the US government, which is pretty much the highest it goes. The US S&P company, which is one of the ones that screwed up the 2008, has been rating it B+ through this whole time, which technically is junk bond territory. Junk bond is a derogatory term somewhat. I mean, it's kind of a standard term these days. It doesn't mean that it's absolutely awful. It just means that there is a chance that these bonds will default. So the rating agencies are, effectively giving these companies way more leniency and credit than they really have. And then, of course, we know this all starts to come around after COVID. It starts to be discovered all of the debt that these companies cover, which, by the way, is absolutely astronomical. So these companies' total value of Chinese homes in developers' inventory hits 52 trillion, most of which is financed. This is bigger than the entire US bond market, twice the size of the US residential market, right? Chinese people have 78% of their assets tied up in real estate, these ghost towns that are a lot of which have gone to zero, compared to 35% in the US. In the US, we famously have a lot of our assets tied up in real estate because of the value of just kind of land here in the US. So of course this plays out. They do eventually end up making money on this. A lot of other people ultimately end up kind of shorting the Chinese real estate market as it starts to collapse. The big difference here is the time frame, right? So from even when the first few people started figuring out what was going on in 2008 to the collapse, we're talking like really honestly probably about 1.5 years. Now the bubble may have formed over, let's say, maybe 3 to 4 years prior to that. So the entire thing plays out over maybe 5 years. Whereas this one was like in full-blown bubble mode starting in 2016. It takes 7 years before it really starts to pop, and the bubble is really still popping. We really don't understand where this is going to result. Now, obviously, the US took a long time to come out of that, and we suspect that China's going to take a long time to come out of this as well. In fact, I'll share a video at the end about in kind of terms of how China is trying to cope with this, and some pretty good signs in terms of the kind of the future of where they're headed. But this is where you can see the difference between a free market, capitalist, whatever you want to call it, here in the US, where when bubbles do form and they pop, although the government does have and should have a role in ensuring that the whole system doesn't go down with it, we'll see, at least in this example, that it pops in a reasonable amount of time so that extra damage isn't done. Whereas in a command system, although the Chinese economy is certainly not just straight socialist, there's a lot of free market elements to the Chinese economy. So let's not try and characterize this as like a purely socialist environment. But in that command system, like those companies expected, the Communist Party did not want their real estate industry to fall apart, so it kept being propped up for years and years. Now, to their credit, eventually Evergrande did go under, and probably several other of these companies, and a lot of these properties are effectively going to be abandoned and show as a total loss instead of continuing to pour money into them and continuing to make the problem worse. However, we see it's taking a substantially longer time, and we really don't know where it's going to end up. Is it going to be worse than us, better than us after 2008? So really, really fantastic article. I will share a link to it down at the bottom. If you did enjoy this, then I do a lot of things on Chinese. Check out this one about really how they're trying to come out of this and really shift towards manufacturing again. Otherwise, I hope you enjoyed the video, and I'll talk to you soon.